Hi, everyone. Thanks for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information here today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation. Attendees are muted, but we encourage you to ask questions using the chat box. We'll have our presenters answer those queries after the presentation today as appropriate. And we may not be able to get to all of your questions, so if you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during the event, we'll make sure someone reaches out to you after today's event. We want to make this as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to today's moderator. And Andrew Jensen is a Senior Wealth Advisor, Director of Alternative Investments, and Investment Committee member at Zermatt Wealth Partners in San Diego, California. Andrew operates as a fiduciary and takes a top-down approach when formulating a client's. Sorry, I lost my space there. He takes a top-down approach when formulating a client's long-term wealth strategy. Andrew augments his wealth management process by working with carefully vetted estate planning, accounting, investment banking, and insurance experts to harmonize each client's entire financial picture while mitigating risks which could derail a client's objectives. And Andrew, I'd like you to go ahead and say a few words about the importance of today's webinar topic. I know, and I'll turn that time over to say a few words.
Okay, thank you, Marche. Can you hear me well?
Yes.
Okay, great. Thank you everyone for joining. Andrew Jensen, once again, Zermatt Wealth Partners. We're based in Southern California. I think we have about 5 offices across the country. And I like to start by, why did I get into wealth management? I actually started in investment banking and real estate, pretty much working mostly with families with closely held real estate. And it was always really enjoyable to truly add value with people. I got into the institutional side. I did institutional investment consulting for about a decade, mostly focused on private equity and hedge fund portfolio construction. And that was great and intellectually very stimulating, but I did miss working directly with people. So I had the opportunity to get back on the person side, the people side, high net worth side directly not too long ago. And I'm really happy to be doing with it. There's nothing like going through a family's comprehensive financial plan and having tears of joy at the end, or just helping people when they really need the help. Things come up in life, and so we help pretty much with everything that's wealth related, and that intersects with most aspects of a person's life. So just briefly on the intersection of wealth management and business owners, our firm does have a bit of a focus on closely held business owners. You're unique, you're much different, your wealth needs in that. Typically your biggest asset, your business, your baby. Our job in that regard, how we intersect there, is to make sure you can be focused on that asset, on growing it, and making sure you get to where you want to go. Also just arriving at kind of your why, which I know Kirk, our speaker, is going to get into, which really is all about creating a comprehensive financial plan to back into what is sort of that net number you're shooting for when you're looking for an exit to achieve all your financial goals, dreams, objectives that your family might have. And there's a lot of other structuring stuff that we look at throughout your business cycle in terms of tax mitigation, asset location, making sure we're diversifying your liquid assets, other ways that the business is not exposed to. And then once you do exit, it's really all about covering the investment models that more than endowment, private equity, private market exposure model, replacing the income you were living off of with alternative sources of income like private credit, cash flow, real estate. But one of the most important things that we do, enough about me, is really working with experts. We don't try to be an expert at everything. We know that there are tax specialists that can really play a role looking at things like R&D credits, estate planning attorneys that we love to use that are really smart at asset protection and intergenerational wealth transfer. And then how we come to today, I've been working with Kirk. I've known Kirk for over 10 years. He has a really great background from wealth management, buy-side private equity, and then having actual true transactional experience, which is really important in terms of exit planning consulting. So I like to work with people I know that produce a great ROI to my clients, and Kirk is definitely one of those people.
Well, I would love to introduce Kirk here. Kirk Mitchie is the managing partner of cont'd Advisors, consultants to founder-led businesses, contemplating capital events and value enhancement. All founders eventually need to transfer ownership or control for their successful businesses. cont'd Advisors ensures entrepreneurs optimize those outcomes, minimize taxes, and achieve their objectives for sustainability, liquidity, and legacy. Mr. Mitchie's areas of expertise include transaction advisory services, mergers and acquisitions with emphasis on founder-owned businesses, corporate and family office governance, capital raising, private equity, corporate strategy, and succession planning. His combination of investment and business experience inform his ability to help entrepreneurs navigate complex entity, family, and legacy decisions. And Kirk, I'm going to go ahead and stop sharing my screen here, and then you can go ahead and take over and share your presentation.
Okay, thanks, Marche. Can everybody hear me okay?
Yes.
Yes.
All right, great. And thanks, Andrew. And thank you all for joining. Hearing that bio, I'm exhausted. I don't do all that every day, but but I do have that experience. So it's nice to be with you. You know, as Marche said, cont'd Advisors works with successful founder-led businesses at 3 different inflection points. So the first one is you've decided to sell, but you're not quite sure who to call first or next. We help you build a deal team to optimize your outcome. Second group of people are the bulk of our clients that are building and enhancing the value of their business, professionalizing things, working over a period of time to make sure that by the time they do go to sell, they get maximum value or employee protection or legacy continuation of their business, and we help with that. And then the last group of people are people that I would say just broadly have some sort of misaligned shareholder interest, right? So it's you and your partner no longer see eye to eye, or your original investors want their capital out, you're not ready to sell, or somebody's going through a divorce and the other person can't buy them out. So we solve for all those kinds of things. And I'd like to kind of broaden the discussion, especially in the Q&A, beyond exit planning, which I think is sort of a limiting way to look at this, and just say, what's the best way to get to the optimal outcome? Because exit planning presumes that you're going to leave the business and the optimal outcome might not. So I'm going to focus in on getting to a sale today, but feel free in the Q&A at the end of my remarks to ask more about other ways to kind of monetize this asset that you've built without actually selling it. All right, so let's move forward. The first critical issue, and Andrew touched on it, is getting to your why in selling. And it's as simple as, do you want to retire, start to take it easier? Are you inspired to do something else and you need to sell this business so that you can be more focused or have the money to endow the next adventure? Are you burnt out? You want to avoid going through another recession in your business and you want somebody else to take the reins? Have you developed successors and you're ready to kind of hand it over, but you're not sure how you're going to take cash flow from this ongoing business? Or maybe you're just paying attention to how much money is out there chasing deals and you want to take advantage of that. all those things are important to understand when you start to think about selling. And I don't mean they're important to understand from just an existential or crunchy standpoint. That's important too, but that's not really the driver. The reason you want to be clear about these things is that the kind of buyer, the structure, your involvement after the sale will all be driven by the answers to these. So it's just really critical to get clear about this. So first, a couple of kind of organizing ideas around that. Look, if you're a successful entrepreneur, especially if you've built a business that has a lot of employees and 8 or 9 digits in sales, you know that at some point your impulses stop scaling. The things that made you a successful entrepreneur to start with, all of your kind of instincts, at a point you can't translate those to C-level executives in your company to continue to use kind of your best ideas on how every decision ought to get made, how all the capital ought to get allocated. It's our experience that usually happens when you're at 20 to 50 employees or more, and usually above 20 million in sales. Now, it's going to be different for a manufacturing company than a software company. But the reason it matters when you're thinking about selling is that your buyer is going to pay attention to how professionally your business is run, especially if your buyer is a financial buyer, like a private equity firm. They don't want to have to get involved in the operations of your business. So to the extent that there's not a lot of delegation, and to the extent that your business doesn't look very professionalized, some buyers might pass. Others might find that to be, kind of interesting or an opportunity, but they'll definitely also use it as a means to buy your business for less. So, the critical things to do, and look, if you've already gone through this painful process, or if you're a member of Vistage or YPO or some other organization that kind of coaches and drives founders towards being more CEOs, you know some of this already. Let me touch on a couple of critical points. All right, first of all, many buyers are going to pay attention to whether you can delegate or not. And they're going to know that based upon, how long it takes to get materials back from you, and whether they all come back in kind of one voice and one kind of, set of spreadsheets, right? That means you don't know how to delegate. And if they think you don't know how to delegate, that could cost you money. And the reason for that is pretty straightforward. They might think that you need to add a controller or a CFO or some other people, and that's going to cause them to change your financials and then pay you less for the business. But if you've learned how to delegate, and if it's obvious, both with your internal team and your external advisors, that can actually mean you sell your business for more because you're more attractive to a broader set of buyers. And one founder that I've worked with a couple of times, who's been through multiple successful exits, just uses a simple paradigm. He says, look, if something can be done 80% as well by somebody else, I'm going to let them do it. I'm going to focus on other things. The other piece is you need to be able to take advice. You're going to hire people that have a lot of experience in M&A, a lot of what I would call reps at the M&A gym. You're going to want to take their advice. Your tendency or impulses that made you so successful early on, and in some cases ignored all that well-meaning but bad advice, this is the time to kind of change that. This is the time to look to the people who've been through this before. And I'm going to touch on this more, and I'm happy to go deeper in the Q&A. And, and then that kind of stepping back and looking at the bigger picture kind of gets back to that why again. So, moving kind of forward in that, most founders have an idea of what they either want or need to get for their business. It is usually not based in the reality of how the market is going to price your business. So let me just kind of give you kind of a brief shorthand on how to think about what your business is worth. Your business is going to sell for a multiple of your financial results, discounted by the likelihood that the marketplace doesn't think those results continue, and or increased or augmented by the likelihood that you've got recurring revenue and a great growth rate, right? And so you might have an opinion or a viewpoint about, my company's worth $100 million. And hey, look, if if you're doing $10 million worth of EBITDA, and you're going to hear that a lot, earnings before interest, taxes, depreciation, amortization, that's the most common metric to have a multiple of when you sell. So look, if the market thinks that like you've got 10 million of EBITDA and assets like yours trade at 10 times their EBITDA, then you have a $100 million company. But if the marketplace views companies like yours as worth 6 times EBITDA, it doesn't matter if you think your company's worth $100 million, the market thinks it's worth 60. You can argue, or you can go back to the drawing board and look at how you build yourself to 10 million of EBITDA so that you get $100 million for your company. Really, really critical to just accept the market's reality here. So if you're not quite where you want to be, like how are you going to get there? Now, some business owners, well, we get asked this question a lot. What about my intellectual property, or what about the value of my brand? And the great news is that those things, they're worth something. They're valuable. And if you're in life sciences or high tech, they might be really valuable. They might be a significant part of your selling price. But for most businesses, they're more value enhancements. They're more things that make buyers attracted as long as the financial metrics are there. But they're still going to buy your business based upon your financials primarily. Your intellectual property is going to create like a moat or differentiation around your business, but it is not the thing that's going to drive valuation. Same with brand. Brand can matter a lot. It's the thing that buyers are going to look at and say, like money can't buy brand. You know, branding takes time. It takes, traction in the marketplace. And so your brand can create a lot more excitement for your business. It can enhance the idea that your company can continue to grow and kind of protect itself. But neither intellectual property or brand are going to be the primary reason that your business sells at a specific valuation number. So what do you do with all this information? Well, first of all, recognize that if you're going to market and you're going to sell your business, assume your buyer is going to be really sophisticated. Don't think that you're going to be able to kind of hoodwink or sell your buyer on the value of your business. Your buyer's going to dig in deep. You should plan accordingly. And what you want to do once you've taken the guidance of your advisors is to understand what the buyers are likely to pay up for and which things are, big caution flags for them. And that becomes your area of focus. You're not going to focus on 10 different things. You're going to focus on just a couple of things. And frankly, one of the most important things to kind of understand in this process, along the lines of those buyers being so sophisticated, is understand that your buyer is a full-time predator and you're part-time prey. Now, what do I mean by that? I don't mean that they're bad people. I don't mean that they have ill motives, but their reasons to want to do a transaction are different than your motivations to sell. You both want the same thing, but you're coming at it from different directions. And here's the thing. If you're an experienced founder who's been through multiple transactions, awesome, good for you. That's definitely going to help. You're going to be somewhere between 0 and 3 transactions in experience. The junior investment bankers that are going to work on behalf of your buyers have been through 30 in the last year. The senior bankers and or private equity people working on putting together indications of interest and letters of intent for your business have worked on 300 in the last 5 years. So the gap in between kind of your knowledge and experience in selling a company, even if you've been through it once or twice before, and that of your buyer is dramatically different. And if you don't have the right advisors on your side, even though those, people don't have ill motives, and even though those people aren't bad people on the other side of the table, they're going to take advantage of the fact that either by structure, you don't understand what they're talking about, or by valuation, you don't understand kind of what the marketplace looks like. If you don't have the right people on your side, you just might sell your company too cheaply, or you might agree to terms that if you'd known just a little bit more, you wouldn't have. But there are cures for quite literally all of this. Okay, so the first one is to do something that can be a little bit uncomfortable. Most people who sell businesses start looking around their network to see who can help them. And maybe they talk to their CPA and say, what do you think? And the CPA says, hey, I've been through this with a couple of companies. I can help you. Maybe, probably not. Or, hey, I know a business broker and like he knows how to put these things together and he'll help you. Maybe. But if yours is a pretty decent sized company, a business broker is probably not the person to go to. They're more like real estate brokers. They don't create the kind of competitive tension that a talented investment banker can, that will maximize the value of your business and maximize the terms that you drive for that. Chances are you don't know an M&A lawyer who can help you. You might know a corporate lawyer. Even your lawyer might have put together your documents and they might seem like they know all this stuff, and they might have even worked on a dozen transactions, or they put together 30 real estate deals, and how could this be that different? I will tell you that in the deals where I see founders not sell for as much as they potentially could, or agree to terms that they probably shouldn't, it's almost always because they're using the wrong advisors. And the most important of those is usually the M&A attorney. You know, the money that you spend on good advisors has really high return on investment. If you've got a company that's going to sell for 30, 40, $50 million or more, you could easily spend a couple $100,000 on lawyers and accountants, and up to $1 million, maybe even $1.5 million on investment bankers. And while those are big numbers and those people haven't been around to create the value, you might sell for 30 million without and 50 million with. You might agree to terms that commit you to risk or involvement in the business that you really didn't want. Whereas if you had the right advisor on your side to work through the terms with you to get rid of all the ambiguity, you wouldn't have agreed to that. If you're not working with an experienced M&A lawyer, and if you're not working with a good investment banker or some sort of transactional advisor, you just won't have that working on your behalf, and it could come around and hurt you. So a couple of things to kind of prepare for and to keep in mind as you kind of move down this track and you start to think about who you're going to empower in the company, which advisors you're going to hire out of the company, and how you're going to think about valuation. This is meant to be a fairly provocative slide, and that is to say, look, you're going to have a feeling about what your business is worth, and you're going to have feelings about the people who get involved and tell you how it's going to work. And those, like all of those, are going to be valid, but don't share them with your buyers. Do not share them at all with the other side of the table. Look, you know, some of the people on the other side of the table are going to be complete jerks. Don't react, right? Share that with your advisors. Talk to your advisors about the fact that it was insulting that the guy minimized how hard it was for you to get traction and build your business here. And it feels invasive and accusatory that they're asking for financial information beyond what you initially provided. And it's just exhausting because they keep asking over and over and over again for more things. Look, if you've got great advisors, one, they'll help you sort through which of these things are feelings and which ones are facts, and which things you need to respond to and which things you need to guard against. And the other more important one is you're gonna need to blow off steam. There are some really, really critical parts to this that are just hard. And if nothing else, you need advisors who've been through this to know which things you should react or respond to and which things you should just let go as part of the process. And remember, this is a process. So I mentioned before that, you know, it might feel invasive and accusatory. You'll go through a process called due diligence where they're going to dig into everything, and you're going to feel like you're in trouble perpetually. You know, the right advisor is going to tell you what to respond to and what to just provide, right? What to push back on, which things to reformat, kind of how to deal with that. So your external advisors, if they've been through lots of deals before, can help you with that. And touch on one other really, really important thing, because this is a kind of well-intentioned or completely understandable and also really, really big mistake that a lot of founders make, who to include internally when you're going to sell your company. So if you're going to try and do it all by yourself, I touched on this several slides ago. Your buyer is going to figure that out. They're going to figure you don't know how to delegate, and they might discount the value of your business or pass altogether. So I'm not saying you shouldn't include anyone internally, but be careful about who you include. And if you're the kind of founder that says, hey, we're a transparent organization and I don't want to be dishonest and I want to be able to look my employees in the eye, so I'm going to tell everybody, good for you. People are going to give you really, really big hugs when you tell them that. Here's what's bad about that. Your best employees are going to start to leave, and they're going to leave before your deal's done. And you're going to start to have gaps in your org chart. And your buyer's going to start to worry about what's going on with your company as important people leave. And then what's even worse is that they're going to come to you and want reassurance that they're going to be okay when you sell the company. And because you're a good person, you're going to reassure them that you'll take care of them, which is going to create either a legal liability or some sort of potential problem at sale. So look, what you need to do here is decide on which critical executives internally should be involved, and you need to lock it down. You need to have a deal team inside. You need to have a deal team outside. And look, you can always take care of your people when it comes down the stretch. You know, in the final week or two, you know, you can let everybody know what's happening, and you can tell them how you're going to take care of them once you know exactly how much excess you have. But what's really, really critical about all of this is just be careful about what you commit to and who you include. And on the who you include, and if I haven't already emphasized this enough, let me double down on it. One of the people to include is either your controller or your CFO, because everything's going to come down to your financials in a frustrating way. No matter what else is special about your business, it's all going to come down to your financials. So if your CPA can't put together presentable financial reports, we need to get an outside advisor in there. There's a lot of companies that are outsourced and do that work really, really well. If your controller's not up to the task, that's fine. Supplement them, right? They might feel insecure about it, but these outsourced firms are terrific at supplementing the work of overwhelmed controllers. And your controller is going to be swamped when your deal goes to sell. So it's reasonable for that person to get some help too. So, you know, whether it's your CPA firm or an outsourced firm, definitely, you know, firm up the financial stuff. And then, you know, lastly, I would tell you that keeping an open mind about the idea that no one interaction with your potential buyer, no one interaction with an investment banker or a lawyer amounts to the entire deal. There are no like mic drop moments. There are no pounding the table and, you know, walking out of the room. There's no screaming matches in good professional M&A. Everything gets worked out. So just remember, you know, a few critical things. One is you and your buyer want the same thing, but you're motivated in different ways, right? So you want the same thing, but you don't exactly have the same households to protect. So just recognize that. Don't take things too personally. The second thing is that between committed buyer and committed seller, there is always a way to get things fixed. There's, you know, kind of a throwaway line in M&A, seller's price, buyer's terms, and then vice versa, which is to say that among a committed buyer and seller, valuation gets fixed by structure, and structure can drive valuation, which is another way of saying, like, you can get the deal done. There's a way to make every deal work. And then lastly, when in doubt, come back to why, right? If you want to sell and ride off into the sunset, and your best potential buyers are private equity firms that want to give you 70% of the value of your business today, have you retain 30% and work in the business for 3 more years until they sell it to the next buyer. If you're really committed to selling and riding off into the sunset, that transaction doesn't work. If, on the other hand, you want to maximize proceeds, and that's the best way to do it, to get what's called kind of a second bite at the apple, Well, then if you're clear on your why and you say, well, I'd be willing to work 3 more years to get double my money, right? Once you're clear on that why, it'll determine, kind of which kind of buyer, which kind of process, what kind of terms. So keep coming back around to that. And now I think I would like to turn it back to my friends to handle Q&A.
Thank you, Kirk. I'm exhausted from speaking so much. That was a really comprehensive, high level. You could talk probably an hour on each one of those slides. A couple of questions that have come up is what is the biggest mistake you commonly see an owner make in this process?
Yeah, so the number one deal killer is seller expectations. And what I mean by that is that, I was talking about how the market decides what your business is worth. And you can't really argue with the market. So instead, you'll argue with somebody like me or an investment banker or the M&A lawyer who is telling you what the market is going to pay for your business. And for the sellers who can't accept that, it doesn't really matter what the buyer tries to do to manage it through structure. The deal's going to fall apart because it's going to cause a chemistry mismatch. It's going to make the buyer feel like the seller's unreasonable. And they're not insulting you. It's just that if they're a strategic buyer, they're buying you because maybe they want to have you be, kind of the new geographic solution for their products and services, and they're going to add your products and services, and they want to be in your geography. Or maybe they want your products and services to cross-sell to their customers, across the US or across the globe. They have specific reasons they want to buy your business. And if your expectations don't align with those things, then a transaction is not going to work. On the other hand, if a private equity firm wants to tell you what your business is worth and tell you how they want to participate and how they want you to participate after the sale, and your expectation is that they ought to be willing to just buy you out completely and let you ride off into the sunset, deal's not going to work, right? There's certain things that are just going to cause a buyer to say, forget it, either because you're perceived to be too difficult or because you just can't get reality. So seller expectations that's the killer.
Yeah, I think you got to sort of wrestle with those demons before you really embark upon the journey at the end of the day. How bad do you want it? And what is your number, your why again? Another good question is, it's really about how do you find the right M&A lawyer, which is absolutely crucial, but there's an entire deal team in place. There's investment bankers, lawyers, CPAs, there's a lot of estate planning and sort of wealth generational transfer structuring that probably needs to go on. There's a lot of decisions that have to get made as you start to think about what is the exit. Is it intergenerational wealth family transfer? You're just transferring within your family, which is not this conversation. Is it you're having employees buying you out, or each want all the options? There's a lot of structuring things that need to go on before, and then as you get close to, most certainly, I'm sure, to give you the most optionality in who can buy your company. So how do you go about assembling the appropriate team and doing that research?
Yeah. So this is a great question, and there's no kind of one silver bullet answer. It does kind of come down to, how big's the company, how sophisticated is the process likely to be, in really practical terms, how much is too much to be paying, the right lawyer, or, is the deal big enough to attract the ideal investment banker? So there's some things like that narrow the choices. But, generally speaking, if you work with a big law firm already and they have a corporate department, they've got some M&A specialists. You may not have met them yet, but the right thing to do, just if nothing else, to save a little bit of time and money in getting somebody up to speed on your business work. If your existing law firm has a corporate department and they have M&A people, then that's probably the best way to go. If you work with sort of a generalist single shingle attorney, that's usually where the problems happen. That person will say, oh, sure, I can handle that. I do that for clients. Well, understand that he may do it for clients that don't necessarily have better options, or he may do it for clients that aren't better informed. But, General Electric is not coming to some single shingle guy in, Iowa City to do transactions for them. That's just not the way the world works. So what you need to think about here is, if they come in with top New York, Chicago, or LA law firms to sit across the table from your lawyer, who are you going to match up with? Because you want that to be a fair fight. You want to be well represented. And pretty much every other choice you make about an outside advisor, kind of comes down to that, right? Like, who are you going to match up with? If they're going to have a big four accounting firm do, their kind of financial due diligence, you're at least going to want to have a big regional or, maybe even national firm do your side of the due diligence on the financial stuff to make sure that you can match up with their people. Because you don't want to be outmatched in terms of advisors and leave dollars on the table that way.
Okay, so we have some pretty detailed questions. Let's keep it high level for now, and we'll see if we can drill down. How do you have, for example, if you have two partners that own the firm 50-50, and they are diverging in their want and their why. One, let's say, wants to stay on for 3 years and collect a large salary. The other wants to cash out immediately. How do you first of all go through advising and navigating and working that out just as their advisor, A, and then B, what kind of structural stuff or capital partners or acquirers, are there people specific to that sort of need or other needs?
So this is a great question too, because this actually comes up a lot, and it's usually because the partners are of different ages. Like maybe one was a lot more senior when they started or had more capital, and the younger one wants to continue on. The older one's ready to move on. So look, if there's still a lot of trust and goodwill between the two, it's not that tricky to work out. A version of, kind of a valuation. Maybe you need to get a third party valuation firm to look at, kind of what the value of the business is, and then just work it out on cash flow, maybe for a period of 5 to 7 years. The buying partner is going to take, 25% of the distributions, and the selling partner is going to take 75% of the distributions. And over some staged period of time, the person that's pulling back, works less and less time in the business, and, takes little or less salary in the business. Like if the two partners get along well already and they just don't want the same thing, and things haven't gotten to the point where they're fighting, maybe they're disagreeing a little bit, they're not fighting, then that can be fixed. If, on the other hand, it's gotten to the point where they can't work together anymore, or the amount of money that it would take one to buy out the other isn't reasonable for the remaining party to stay, there are hundreds of private equity firms, and I'm not exaggerating, there are hundreds of private equity firms that do structured equity deals where they buy out, partners, soon to be ex-spouses. I mean, it's a business model for some of these financial sponsors to do that. And sometimes they'll come in and let's say they'll buy 49%, or they'll buy out one partner entirely, but they'll be 49% of the remaining equity, and they have some controls, and maybe there's some debt on the business and some other structure to it. But the remaining partner still gets to run the business. He just now has a financial partner rather than an operating partner. A lot of ways to solve this one, and the critical thing here is kind of get some outside advice sooner rather than later. Because if it goes on too long, then they eventually kind of end up like needing a divorce, and nobody maximizes dollars coming out of a scenario like that.
Okay, I have a little more detailed question. So I think they're pretty related. I'll take them together. One is residual income versus cashing out, which I think is somewhat related to, I could pull a couple of million out, but I can only get a year in income from my business from operating, but I can only get 4 million in the sale. Does it make sense to bring in a management team and then have your residual income essentially?
Yeah, this
I
one
think
comes
there's
up a lot.
probably-
Oh, sorry, Andrew, I cut off the end of your,
I'm sure there's a lot of detail really around the industry and,
yeah.
yeah.
This one comes up a lot because there are a lot of businesses that private equity buyers would call lifestyle businesses. And it's not a pejorative term. They're not saying, it's not a great business. They're just saying that, if you can pull $1 million or $2 million a year out of a business that you could only sell for 5 or 6 million. And if you're a California resident and you sell a business for 5 or 6 million dollars and you give up 38% of the 5 or 6 million in taxes, your net after tax is barely going to cover a year and a half's worth of the distributions you were taking out of the business. That's not a sellable business. That's a lifestyle business. The simplest thing to do on a business like that is either, depending on how long-term your employees are and depending on kind of what the structure of the company looks like, either develop or find a successor so that you can effectively become like a limited partner in your own business, right? So you step back as if you're kind of the landlord, and the building keeps operating. You retain your equity, but you incentivize this, your successor with maybe some phantom equity to start with. They've got to earn their way into it. They don't just get the equity right off the bat. They've got to maybe, earn it in a 5-year like cliff vesting schedule where they would just, maybe they get 20% a year, but they don't get it until they clear the 5 years. And you're certain that you then want to, give them some of the equity in the business to run it while you kind of take off in retirement. And you get that way, you as the founder get to continue to kind of coach and mentor them and make sure that the transfer of kind of tribal knowledge in your head gets to them before, you're frustratingly working on a golf handicap that's not going to go down, but you're going to keep working at it anyway.
I can relate to that, unfortunately. Yeah, it is a tough game. So we talked about structure a little bit, and I know we've talked about this a lot over the years. What are kind of the more hidden key structure elements in a deal where people can end up the most exposed, either from a liability perspective or where valuation can really be affected, maybe even post the initial part of the transaction?
Yeah, well, this one, and you're right, we've talked about it because we, like as financial guys, what's interesting about the difference between, say, private equity people or investment bankers and operating people, business people, is that financial people love structure and operating people want things to be, like straightforward. Who does what and what do I get paid for that, right? So what's most common in what you would think of as a buyout, and most, I probably should have said this at the start, that the least common transaction when you're selling your business is you get 100% of the proceeds in cash in your bank account at close and right off into sunset. That is the least common. Most common is that at least some of the money is escrowed for, representations and warranties to make sure that when you told them that nobody was suing you and you told them you had no products liability and you told them those accounts receivable were good as far as you knew, and you told them those contracts were legit as far as you knew, those are all representations and warranties you've made to the buyer. They're going to hold some of the money in escrow, even in an all cash deal, to make sure that that's true. And they hold it for, say, a year, and then escrow is released and you get your money. And there's usually, a basket, like a minimum on those numbers, and a cap, a maximum on those numbers, right? So there's usually a little formula in there. Most deals, on the other hand, are what you would call a majority recapitalization transaction, which is a fancy way of saying they give you a certain amount of cash at close, usually more than 51% of the overall valuation. They probably ask you to take back a seller note. In really, really big transactions, seller notes are uncommon, but transactions below 50 million, there's often a seller note where, you're getting paid a higher than market level interest rate to essentially finance the buyer on your business. A little bit like taking back paper when you sell your house, right? So there's usually that. And then there's usually some, what I would call rolled equity, right? So, they're usually going to want you to maintain some equity exposures. If it's a financial buyer, they're going to want you to maintain some equity exposure in the business. That, interestingly, is more risk control than anything else. See, if it's in your financial interest to make sure that they continue to operate the business effectively, at the point somewhere between close of escrow and 6 months afterwards, when you can't stand your new private equity overlord, you're going to want to say, F you people, I'm out of here. And if they've had you roll equity in the business, that will hurt you, right? That's why they had you do that, right? So, those three pieces of structure, cash at close, seller note, and rolled equity, most common. If it's a strategic buyer, a company in your own business, then chances are they might give you some of their stock, especially if it's a public company, but you don't have any ongoing operating responsibilities, so it's just going to be cash and stock. And then there are others, on what you call kind of growth capital or minority deals, where let's say you're buying out your partner, a mezzanine finance or structured equity firm comes in and comes up with some sort of combination of kind of high interest debt and preferred equity or something like that. But most common is that majority recap. So, cash, seller note, rolled equity.
You alluded to the private equity overlord now owning you, and I can attest to that. For example, some of the software buyout funds that we provide capital to as investors, for a software company, they'll go down to like daily or even hour by hour data that they're requesting from the business. So it's much more intense even than a quarterly earnings call can be, but usually constructive intensity. Usually there's a value additive component. How important do you think that is for many sellers that you work with in terms of a constructive, often there is some sort of equity kicker or component or residual income or equity in the company. How important is the profile of a buyer?
Yeah, so it kind of depends on who the private equity buyer is. I recently worked on a transaction that's closing this week where it's a successful company does about 8 million in EBITDA on about 65 million in sales. And transactions in this sector are happening at 6 or 7 times EBITDA. So call it 50 to 60 million-ish. And on this one, we got 11 indications of interest, 3 from strategic buyers, companies that would just swallow it up and give them all cash at close. And then all the rest were versions of financial sponsors, private equity firms. And the most attractive of the private equity offers was from what's called an independent sponsor. Now, an independent sponsor or a fundless sponsor is a private equity firm that doesn't have a fund. They raise money one deal at a time, and they might be really experienced deal guys, but they don't generally have a track record. And there's generally going to be other influences on the deal. So these guys have to work harder to build rapport with sellers because their deals are more complicated and more difficult. On the other hand, we had a deal that was about 10 or 11% below their offer from a private equity firm that has generated average annual returns of 14.5% a year for the last 22 years. And so, and like if you're in the investment business, lots of numbers get thrown around. 14.5% a year for 22 years puts you in a hall of fame, like up there with like the Warren Buffetts of the world. These are great investors. So the calculus was, can we get the 14% a year guys to increase their offer by a little bit and use the guys who were offering more money, the independent sponsor, as like a stalking horse, right? Use these guys to get these guys to be willing to pay more money. We did. And so now my guy who was given the option, my client was given the option of rolling at least 25% and up to 45%. We did an analysis of the private equity firm's returns. And structured it in such a way that, he can defer tax on a lot of his roll. And so he actually rolled 40% of his equity, because now he is the second largest investor in his business, and he's now part of their fund. And he was going to be a big investor in somebody's fund anyway. So why not the guys that are buying his business, right? So it's a little complicated, but it's important to not sort of think about all private equity firms as a monolith. They have track records. And the other thing we did was go talk to the other companies that this private equity firm had bought. We asked for, 4 references to talk to CEOs who were now part of the portfolio of that private equity firm.
Well, the good news is, I think the private capital markets have pretty much displaced much of the public markets at this point in time. There's what, 5.25 trillion of private equity fund AUM out there, private equity combined with private credit. So there's a lot of capital providers and solutions in every sector, and every geography. So there is a lot of solution out there on the buy side.
Yeah.
How important is it, at what stage, and I know my answer, but when do you typically think it's very important for founders to get very focused on structure from a tax perspective?
So you don't want to count your chickens before they hatch, right? But you do, like, so I'm working on a deal right now where it is like the tax piece is like from the indication of interest phase. We got an unsolicited offer from a public company to buy my client's business for $180 million. We went back to him and said, from a valuation standpoint, this part of our business is worth at least 250, and the entire business is worth more like 450. And we thought that was the last we'd ever hear from them. And they came back to us and said, okay, we agree 450. Now understand, they came from 180 to 450 like that, right? So they, and my client's business, by the way, is growing at more than 100% a year. And my client would be able to take somewhere in the neighborhood of 20 million of distributions out of his business in his 4th year of operation. So it's a fabulously successful, rapidly growing business. They came back to us with an asset purchase, right? There's 2 different ways to buy a company. You're either buying the stock, the entirety of the company. So that includes everything in the company, including its ongoing liabilities, or you're buying the assets of the company and you're picking and choosing the liabilities. For most buyers, an asset purchase makes more sense because they get to step up the basis to whatever they paid for it. And then they get to write off the goodwill and intellectual property in the company over a 15-year period of time. So if they can ascribe most of the value of the company to goodwill and intellectual property, they'll write off the entire purchase. And if they have outside investors, they'll actually push through those tax losses to their investors. A lot of private equity firms do this. My client, however, has a C Corp. So an asset purchase of a C Corp means my client pays, the corporation pays taxes. So in this case, 450 million with 0 basis. So 30% goes away right away. Then the balance is distributed to the individuals who pay their capital gains tax at both federal and state levels on the remainder. So in effect, double taxation. The reason I bring this up in this case is that we brought in a tax lawyer and an M&A tax specialist on the accounting side to help us respond to that letter of intent, to restructure it, to say, okay, we're in agreement on valuation. Like, we nailed the hard thing, right? Now let's work on structure. And it's still going back and forth, but what I can tell you that the net present value of the public company who's buying our company, by doing this as an asset purchase, the net present value of their ongoing 15 years worth of tax benefits is about $65 million. Meaning we just took what they, kind of get to write off for the next 15 years and discounted it back to today. And we're about 50 million apart right now. So we've closed about 15 of the $65 million gap, and all the rest of it's going to be tax, right? For most sales, Once the letters of intent come in and we're down to, say, looking at 2 or 3 letters of intent, kind of the 8 to 10 page letter from the buyer that says, here's roughly how much I'm going to pay. Here's what I want for due diligence. Here's the structure I intend to use. Here's how I want you involved after the sale. Usually then we would turn to both a CPA and a wealth advisor like you, Andrew, and say, okay, tell us, model out these outcomes and show us which one is better for my client's family. Which one's better after tax, which one's structured better from an estate tax standpoint, which one's structured better for kind of building up more money over time. Because we think of it as endowing the rest of the client's life, net of inflation, taxes, and expenses to make sure they never run out of money, right? And that's when we turn to you and the CPAs to do that tax planning.
And that's why when the liquidity event happens, if it's the first one, the whole investment scheme shifts to more of an endowment style, right? So where their big asset was their closely held private asset, and then providing them exposure to third-party private assets is huge. And it usually corresponds well with the business owner versus a stock and bond Monte Carlo analysis, part of the puzzle. But okay, I have a valuation question.
No, we'll just have to break in here. That will have to be our last question because
Okay,
we're coming to the end.
So, and you probably don't know this off the top of your head, but what kind of multiples are you seeing? This is the construction industry, roofing. I'm not sure if it's commercial or residential, but what are you seeing in that type of industry? 10-year-old company, 12 million a year in revenue. Okay. This ballpark.
So thank you for the caveat and the out clause. I'll make a distinction here between project-based businesses, which is what roofing companies are, and businesses that have customers and ongoing revenue. So even if you're as a company in the building trades, you're sort of, even if you have 20, 30 years of experience and a lot of repeat customers, you don't really get credit for recurring revenue. It's thought of as, so you get kind of discounted back. And most of these businesses run in such a way that they don't have a lot of distributable profits. So they're usually looked at as, a purchase as a percentage of their revenue, right? Because they don't, in many cases, have EBITDA. When they do, they tend to trade for, if they're below $1 million of EBITDA, then they would tend to trade for 2 to 4 times their EBITDA. And if they're above $1 million in EBITDA, they might trade for 4 to 6 times. And in a frothy market, getting any more than 6 times would have to be a pretty big business that's getting tucked into, kind of a private equity firm's roll up of a bunch of building products companies. And this one just happens to fit this geography and this style or, kind of set of materials. Yeah. Those are really, really good ESOP transactions and management buyout transactions. So, I know we're running out of time, but one of the things to look at with a project-based business is if you sell your business to your employees, and there's a lot of bank financing out there to do this, and let's say you don't even sell the majority, but you just decide you're going to kind of do a combination of having a successor and selling a percentage to employees, and they're going to finance it with bank debt. And let's say you take, $3 million in chips off the table because the bank financed it and the company can afford to pay the bank debt. If you reinvest that $3 million in what's called a like-kind corporate security and then borrow it out at essentially the same rate that, there's a way to do this that involves a little bit of gymnastics, but it's all totally legal. You don't pay any capital gains on that $3 million you took out of there. So sometimes in a lifestyle business and or a project-based business, an ESOP transaction is a great way to take some chips off the table on a tax-free or heavily tax-deferred basis. Yep. And maintain, getting distributions out of the business.
And have invested.
Folks, thank you so much. Kirk and Andrew, on behalf of Advice Chaser, thank you so much. We want to thank the organizations that have worked to bring you this webinar today. Thank you to our attendees for attending. Look for an email soon with a replay link for this event, and you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Bye, everyone.
Thanks, Marche. Thanks, Andrew. Thank you all.